Morning everyone, and welcome to Econ 340. This is the honors section. We will be discussing international economics. So without further ado, let's get started. Now, I have a Mac at home. I'm not too used to these PCs. Let's see if I can get this thing to work. There we go. Okay, here we go. So, the U.S. and the global economy is the main focus of our first chapter in the book. Before we can begin to understand the impact of the global economy on the U.S. and vice versa, we need to know the ways in which economic integration can be measured. Now there are four ways. The first is trade flow, second is capital flow, then people flow, and then similarity of markets. Does anyone have an idea of what trade flow is? Jordan?
Isn't that just the amount of exports and imports that a country has?
Yes, it is. It's a pretty simple concept to grasp. And the amounts of trade a country has can be used to determine the trade to GDP ratio, which is a measure of importance for that country. Now the trade to GDP ratio is calculated by adding both the exports and imports for a country and then dividing them by the GDP of that country. So now we need to know what the GDP is. Does anyone know what GDP stands for? Yes?
I think it's gross domestic product.
That is right. And it's used to measure the total production for that country. In general, a larger country will be less dependent on trade, and smaller countries are more dependent. Think about it. If a large country has a large GDP, then the fraction will be smaller, meaning it is less dependent on trade. Whereas a country that does not have a very big GDP has a smaller number on the bottom, making the fraction bigger, meaning that they have more dependence on trade. Can anyone tell me the most dependent and independent country over the last century according to this graph? Jordan?
The Netherlands would be the most dependent because they have the highest GDP to trade ratio.
That's right. And then do you know who has the least dependent?
The United States?
Yes, that is right. Now it is important to note that the trade to GDP ratio determines a country's dependence. Although a country might not be very dependent, they are not close to the rest of the world. Instead, they are just not dependent upon them. Now, does anyone notice anything funny about this graph? How about all the way for every country it kind of slopes down and then comes right back up? Yes?
Well, that decline's about where World War II was. Did that have something to do with it?
Yeah, and the Great Depression, that was around then too, so that might have affected the GDP of the countries.
Very good. You guys are both correct. When the economy was down, there were less economic flow altogether because countries were shutting down communication with other countries for safety. This led to the decrease in overall GDP across the nation. Economies are now integrated to such an extent that various countries are now producing certain parts to collaborate into a single product. For example, iPhones. They have parts made in 4 different countries, those being Germany, Japan, the US, and the Republic of Korea, and then are assembled in China. Then they are shipped back to countries they might have had parts made in to be sold. Now there's a potential problem. More trade means lower prices and greater choices, but also means more competition for firms and workers. Now we have to take a look at capital flow between countries. Capital flow consists of both paper and physical assets. The amount of capital flow has increased over the years quite a bit. Does anyone have an idea as to why this might be? I'll give you a hint. The iPhone example we just talked about. Yes?
Would that be technological advancements?
Exactly. They have made it possible for the global market to move faster than it ever has before. Because of things like the internet, other telecommunication methods, we have a very open market that has pushed international production to new levels. Investors are also finding better places to invest their funds since it is so easy to communicate. They are finding investment opportunities in virtually every sector of countries' economies. As you can see in this graph, there's been a dramatic increase in the amount of capital inflow over the past century. Now there's a potential problem with capital flows, and that is that more funds available for investment, but increases the risk of spreading financial crisis internationally. An example of this is the US dollar. The US dollar is in most international transactions, meaning that anything that happens in the US economy will affect international finances And the largest way the U.S. affects the world economy is through buying power. The recent downturn in spending has an impact on nations with less stable economies because they would be less capable of buying American exports, furthering the downward spiral. So now we're going to talk about some people flows. Does anyone know what this means? Human trafficking, slavery? Yes?
Probably just immigration. The others seem a little extreme.
And why would immigration be important or matter to the U.S. and global economy?
Because the more people there are in a country, the more competition there is.
That is right. So what causes this increase in competition? I'll tell you. It is because there is a better skill pool and lower labor costs in the countries that the immigrants came to. This can then lead to more social tension and can cause problems in economies. A potential problem arises, however. Rising immigration means higher incomes for migrants and lower labor costs or a better skill pool for firms, but also means more competition in labor markets and greater social tensions. Let's make U.S. as an example of how immigration affects our economy. Both high and low skill immigrant labor creates additional jobs across the U.S. economy. With immigration reform, newly authorized immigrant workers would produce enough new consumer spending to support 750 to 900,000 jobs. Every additional foreign-born student who graduates in science, technology, engineering, or mathematics, also known as STEM, and remains in the U.S. creates an estimated 2.62 American jobs. Every low-skilled, non-agricultural, temporary worker who comes to the U.S. to fill a job that may otherwise be left open creates an average of 4.64 U.S. jobs. These low-skilled jobs are the necessary backbone to support high-skilled positions. Passage of the DREAM Act would add $329 billion to the U.S. economy and create 1.4 million new jobs by 2013. Now, immigrants are more likely to be entrepreneurial and to start new businesses, which in turn create jobs for U.S.-born workers. Immigrants started 28% of all new U.S. businesses in 2011, employing 1 in 10 U.S. workers. Immigrants represent 18% of small business owners in the United States, exceeding their share of the overall population, 13%, and are more likely than those born in the U.S. to start a small business. Immigrant-owned small businesses employed an estimated 4.7 million people and generated an estimated $776 billion in receipts in 2007. More small business owners are from Mexico than any other country. Over the past 2 decades, immigrants made up 30% of the growth in small business creation. Immigrants founded 18% of 2010 Fortune 500 companies, creating jobs for 3.6 million people. When including immigrants and their children, the number of Fortune 500 companies with immigrant roots jumps to 40%, employing more than 10 million people. Immigration could bring benefits to the U.S. So does anyone know what caused people moving between countries and what kinds of influences for those countries who lost their labor focus? Yes?
Could political issues have something to do with it?
That is a good guess. Actually, you're partially right about this. If we look widely in the global economy between the 20th and 21st centuries, there are many real-world examples showing what make countries want to absorb immigrants and also lost domestic labor force. Argentina is a perfect example of this. Argentina, that at the turn of the 20th century was both a net immigration country, absorbing large contingents of immigrants coming mainly from Spain and Italy, while being a net importer of capital, chiefly from Great Britain. That situation reverted in the last decades of the 20th century and early 21st century as Argentina suffered from emigration flows, particularly of high skills people and professionals, due to the poor development prospects of the countries and the lack of democracy during authoritarian periods. So let's look at some similarities of price in different markets. Yes, Jordan?
Do we have to remember all those? Is all that going to be on the test?
You just probably should know like the concepts behind it all, and if you do that, you should be fine for the exams.
Okay.
So now we're going to talk about the similarities of price in different markets. So what keeps prices from varying? The last measure that we have to discuss is the similarity in different markets. Some countries obviously have the power to produce some products at a lower price. So once again I ask, what keeps pricing from varying?
Well, I think it'd have to do with just the aspects of trade influence, wouldn't there be? Because people can trade, the prices should somehow level out.
Yes, but why do you think that trade is influencing that?
Because if I can buy something at one location for a cheaper price, why would I go to any place that's more expensive?
Yeah, that is right. So goods that are more freely from a low cost to a high cost region should experience some price convergence as goods move from where they are plentiful to where they are relatively scarce or more expensive. Think about this in terms of oil exports and imports. Oil could be extremely cheap in countries where it is plentiful. In countries where it is scarce, it would be very expensive. But because of trading, these prices level out. Why would this be? Because the people who are willing to pay more because of its scarcity would be willing to pay a higher price, so it would get exported, making the price also higher in the country where it was originally plentiful. Therefore, the prices will eventually level off, making them very similar, aside from some costs of transportation that might affect the prices slightly. So I know we covered a lot today. If you guys have any questions at all, or maybe want to do any additional research, I have our sources posted here. Like I said, as every class, I'll post these slides to D2L. Also, as a little review for you guys in studying for our exam next week, if you guys can answer these 3 questions, that's pretty darn good. You're on the right track to doing well on the exam.